I want to help y'all see around the corner. My topics that we're going to cover today, we'll talk about the economy, and the good news is the U.S. economy is stronger than you think. And then we'll talk about some of the major trends that will impact your business going forward, and then where there are some threats and risks, as well as opportunities for ports in the future ahead. So as I mentioned, the U.S. economy is stronger than you might be thinking. U.S. GDP in Q2 was 3%, which is a really good number. We're going to get another GDP print very shortly, and at 2.8% is what the GDP Now number was for the third quarter GDP expectation. And as we look at the global expectations for the IMF World Economic Outlook numbers, with GDP at this level in the US, the expectation for the full year is that it's going to be around 2.8% for 2024 and around 2.2% next year in 2025. Now, that means that in 2023, when GDP was 2.9%, U.S. growth was the fastest growing GDP in the world, of advanced economies in the world. And this year at 2.8, it will be the second fastest growing advanced economy, just behind Spain. In 2025, even at 2.2%, it will be among the fastest growing advanced economies. So the U.S. has seen significant strength, one of the fastest growing advanced economies. And of course, at this 2.9%, 2.8% levels, these are GDP growth rates that look more like an emerging market than an advanced economy. And as we look at other economies across the world, I think the thing that raises eyebrows is what we see with, say, the Chinese economy, that last year grew at 5.2% and this year is expected to grow at 4.8%, with next year around 4.5%. So a slowing in Chinese GDP growth, whereas in the US, even though it's slowing, it's at still very high growth rates for an advanced economy. The labor market is also stronger than you think, and it's really important for GDP. So with US GDP at a really strong level, right, how do we get there? Well, 70% of US GDP is driven by consumption. It's people buying stuff. And the good news is people with jobs buy stuff, and we have a lot of jobs in the US economy. A couple of key data points that are really important is that the unemployment rate, which you see up here on the left, that shows, a rise in the unemployment rate. And that's not good, but 4.1% is a relatively low number. The graph next to that is non-farm payrolls. And you can see that the non-farm payrolls number, that has been consistently positive. So we've seen month after month after month of positive payroll gains. This Friday, we're going to see another GDP or another payroll report that's likely to be positive despite the impacts of the hurricanes. It should still be positive. And the unemployment rate, that might continue to rise. The reason it's rising, though, even though we have positive payrolls, is that the number of people looking for work is going up faster than jobs are being added. It's not because we're having months where jobs are being lost. And the truth is that payrolls right now are at record all-time highs. 159.1 million jobs in September. So there have never been more people on payrolls in the U.S. economy than there are right now. And the labor force is also at a record level, 168.7 million in September. So really strong. So more people on payrolls than we've ever had, with a bigger labor force than we've ever had, and very low jobless claims. Even though the unemployment rate's 4.1%, it's been going up. 4.1 is low, and the percent of people collecting unemployment is only 1.1% of the labor force. So that's an exceptionally low level as a percentage. Less than 1.9 million people are currently collecting unemployment. That's good. And there are a lot of open jobs. There's over 7.4 million jobs open in September. So lots of people with lots of jobs, very few people collecting unemployment, and a lot of open jobs. By the way, before COVID, there were only around 7 million open jobs. So we're still above that level. And it has slowed from March of 2022, when the peak level was 12.2 million. You can see it there. That was 12.2. There are fewer job openings now than then, but it's still more than there were before COVID. Now, because people have all these jobs, that's really good, but the labor market's also really competitive, and that's been driving up wages. Wages are up $6.81 an hour just since February 2020 when COVID started. And I mean, to me, this is a mind-boggling number. I remember working for $4.25 an hour in my first job. I mean, it was in the 1900s, but like it was the late 1900s. But this is a lot, right? And so this is both a product and a function of a tight labor force. And you've got more people on payrolls we've ever had making more money than they've ever made. So while this is a challenge for companies, and I'll talk about the implications for ports in a second, it's also really good for consumption, right? Because if you got more people with more jobs making more money than they've ever made, they're out there buying stuff. And we had a record level of retail, trade, and food services in September, $714.4 billion. All-time record. And what's really important for the supply chain is we also had e-commerce record spend in retail in Q2, $291.6 billion in Q2, record all-time high. And as a percent of total retail, e-commerce was 16% in the second quarter. Now that's the second highest percentage ever. The highest percentage was 16.4% in Q2 of 2020, back in sort of the worst parts of COVID. The reason I mention this is stuff is moving through the supply chain faster than it ever has. And we're going to continue to see that demand. Lots of people making more money than they've ever made, using a faster distribution chain than we've ever seen. That's going to put stress on the ports. It's going to continue to just drive consumption in a big way. And I'll add another thing to consider, which is that debt delinquencies are super low at only 3.2% for consumers in Q2 of 2024. Total consumer debt's a little bit less than $18 trillion for the US consumers. But with only 3.2% of debt delinquencies, that means people don't owe that much money. They're not delinquent on much. Compare that to, say, back in 2009, when the peak level was almost 12%. And 70% of all the consumer debt in the US is mortgage debt. And mortgage credit quality has never been as good as it is now. What this stacked bar chart shows is credit quality and dollars originated for mortgages. The colors are the most important thing. And this icy blue color here, this is people with 760 plus credit scores. 68% of all mortgage dollars originated since Q1 of 2020 went to people with 760 plus FICOs. So again, more people with more jobs than we've ever had making more money, owing what prior to 2021 would have been the lowest debt delinquencies in U.S. history, with the highest credit quality mortgages we've ever seen, locked in at the lowest interest rates we've ever seen. That's all really positive tailwinds for the U.S. economy, which is, just shy of 3% annualized. Like, that's growing at almost emerging market rates. It's all very positive. And interest rates are also poised to fall from here, which is a positive dynamic for growth. And business investment will be encouraged by lower interest rates. But the Fed's going to have to do it slowly, because even though inflation's come down, which is also a good thing, inflation rates are still a bit elevated, right? And we can see that in the headline CPI number, which is 2.4%. Fed's target's 2%. But the core, which is inflation, which excludes food and energy, that's 3.3% in the latest print. Two things are going to happen in the next 6 months. The headline number, which is 2.4, is likely to go up, potentially towards 3%. Not because I'm expecting more inflation, but because of a base effect in the historical data. So the reports that come out in December and January, which will respectively be the November and December reports, those reports could be close to 3% for the headline. And people might freak out a little bit. We might see a response in the bond market. We might see a response in the equity markets. Oh no, inflation's going up. The Fed won't be able to cut rates in 2025. But because of the data that's also behind us, we could see inflation rates for CPI in the second quarter of 2025 around 1.5%. And now suddenly the little kid soccer team will go from the Fed won't be able to cut rates in 2025 to, oh my God, there's got to have an emergency meeting and cut 100 basis points tomorrow, later today, oh my God, right? So you're going to see that shift probably in the next 6 months because of the historical data that's already baked in. All that's very positive in many ways. Of course, one of the biggest challenges for ports is going to be the labor issue. And for many businesses, this is why things like AI have gotten a lot of attention, right? But there's many things AI can do, and I'll give you a few examples that might be helpful to think of as you leave here. But the most important thing that AI can't do is move physical goods and operate trucks at the moment or certain equipment, and there's a lot of things it can't do, which is why there's almost 300,000 open jobs right now in transportation, warehousing, and utilities, and why there's almost 500,000 jobs open in manufacturing, and why there's almost 300,000 jobs open in construction. And that's before interest rates go down quite a bit further. So there's some things AI can do, and there's some things it can't, right? If you look at the number of job openings, physically demanding in-person jobs have become tougher to fill. It is very competitive out there. And the hope for AI, like there is opportunity, but I feel like right now, the way people talk about it is the way my grandparents would talk about a diner, right? Like, if you're gonna go out to eat, we should go to the diner. Why? Well, you can get whatever you want. What do they have? Oh, they just have everything. What do you mean? Oh, yeah, like whatever you want. It can do like everything. And that's how I feel people are talking about AI right now. The value add is probably in mid and back office functions, especially in physical businesses. And the definition and the opportunity, I see it as, have you ever described a task as standard or boilerplate? Think about using something like generative AI for job postings, sales scripts. I've done this. The American Logistics Aid Network, Alan, they have been created across a number of different industry groups to support the economy when there are disruptions in supply chain. A couple of years ago, they had me do a talk about what could you do with generative AI. And in a 20-minute period, prior to our call, I figured, well, let me see what I could do. And pulled up ChatGPT, and I decided I would create a number of deliverables as if I were the CEO of a warehouse company looking to implement automated guided vehicles at a warehouse. So I had it first draft me a job for a chief procurement officer to run the project. Then I had it draft a request for proposal. I had it draft letters of proposal coming from the company, putting in the proposals. These are multiple pages long, including all of the capabilities of the team and how long our history was. I mean, again, I just created this idea 20 minutes earlier, but it talked about our varied skill sets, our multidisciplinary team, and all the opportunities and high caliber talent we have. And then I had it draft a project plan, press releases, everything in under 20 minutes. Before I started Prestige Economics 15 years ago, almost 16 years ago now, I worked at McKinsey. And we did projects kind of like this sometimes. And it would have taken an EM, a manager, plus 2 or 3 people, a week or two to create those deliverables. That's somewhere between $500,000 and $800,000 of economic value created in a 20-minute use of ChatGPT. So there's a lot of opportunity here. Put another way, I had a junior analyst working for me. And I used to have him do press releases for me. He would take like a week to put together a press release, and it wouldn't be very good. And I loved my junior analyst, but he could not write a press release to save his life. And so he put the thing together, and I didn't want to hurt his feelings. Like, I love the guy. Like, he's my first cousin. So I'd tell him, yeah, this is great. I'd have to, just do my own and send it out. It turns out he was a really great sales guy, and that's what he's off doing now, tech sales, and he is a rock star. And ChatGPT makes my press releases. And is it 100% accurate? No, but it's 95%. It's pretty good. I'll take that. You move from creating to editing, that's great. It's really great for corporate drivel. There's a lot of corporate drivel up here. Other AI that uses statistics and numbers is really good for predictive analytics and forecasting, risk management, loss prevention, audit and compliance, right? The National Association of Corporate Directors had KPMG do a project for them, and the results were out of 1,800 executives surveyed, 100% of them expect to be using AI in 3 years in their financial operations. And 97% expect to be using generative AI in 3 years. So if you're not using this stuff, you really are at risk. It's like when digital spreadsheets were created. You know, I was born here in Boston, raised on the South Coast, only about 40 minutes from here. My grandfather ran an accounting firm. And I remember in 1983 when Lotus 1-2-3 was introduced, and it was a big deal, right? This is the first forerunner of Excel. And some people in the accounting world were like, yeah, I'm going to get right on the digital spreadsheets. And other folks, no, I'm not going to use it. The folks that resisted either came around quickly or their businesses were gone, their careers were over. The same thing is a risk for folks around AI and generative AI. But it's a big opportunity, lots of leverage. It's great. So let's talk about some risks. The biggest risk that I see out there right now is Cold War II, something we've been talking about long enough to have trademarked it, and those risks are probably bigger than you think for supply chains and port dynamics. It really, even though we've been talking about this for a little while, right, a few years plus, it really starts to kick off on February 4th, 2022, just a few weeks before the Russian war on Ukraine. What happens? There's the Beijing Olympics, and at the Beijing Olympics, China and Russia get married. Make no mistake, you can find the statement on the Kremlin website. China and Russia say that they strongly defend the outcomes of the Second World War and that there's no limit to their cooperation. Totally normal thing to say in the mid-1900s, really weird to say in 2022. The big takeaway from this map of 1945 is Russia bigger, China bigger. And I wonder, I think about, maybe we made the wrong deal at the end of Cold War I. You know, a lot of historians today will tell you, European historians, look back at World War I and World War II, and they'll tell you it was one conflict with a 20-year armistice to answer what's called the German question. And I wonder, 50 or 100 years from now, historians will look back and they'll go, okay, well, the Cold War was a 100-year conflict with a 33-year armistice to answer the China question. And the seeds of World War II were sown with the end of World War I and the Versailles Treaty, and the seeds of Cold War II are sown with Nixon's China moment. Earlier this year, I was with a friend of mine, a professor, a former professor now of National Intelligence University, and we had a little time to kill in California, and we went to the Nixon Library at Yorba Linda. Not a Nixon fan, long story, I'll be happy to share sometime. But we went. It was an interesting way to kill some time. And this picture is everywhere. This is Nixon's China moment. This is Nixon's mission accomplished moment. Because in this moment, Nixon and Kissinger write a check to Zhou Enlai, the Chinese premier, and Mao Zedong. And the check is pay to the People's Republic of China in the amount of 1 Taiwan and 00 of 100 cents. For the young people, a check is a way in which you... The cooperation between China and Russia is a really big deal, and it's been ramping up in recent years. This is just some of the military exercises they've done this year. All over Asia, even in Europe. They're doing joint military exercises, and they're not alone. They've created a coalition of the post-Cold War disgruntled. Just a few weeks after their wedding, Russia invades Ukraine. And the map has changed not too much in a few years, or well, in the last year or so. A couple things. I mean, we now see that Ukraine has had incursions into Russia. But just about a week after this, I remember giving a talk in very early March of 2022, and I said, I think the outcome of this war is probably something that looks like Korea, right? There is no peace treaty to the Korean War. You end up with a begrudged armistice, a demilitarized zone, a country that's carved up and at war for the better part of this century. And it's unlikely to end soon. One of the master's degrees I did was in negotiation and conflict resolution. And there's probably the most valuable thing I took away from that degree was, if you're in a conflict and you're not going to win, make it bigger. So Cold War II's second front opens October of last year as Hamas attacks Israel. Make no mistake, this is part of the same conflict, right? Who sells drones and ballistic missiles to Russia? Oh, it's Iran. Who trains Iran's proxy, Lebanese Hezbollah? Oh, that's the Russian mercenary Wagner group. Where does the money come from? Oh, that comes from Iran. The Houthis that have been harassing the shipping channels, most important for supply chain, something that's going to reshape port demand going forward. Where are they getting their ballistic missiles and drones? These folks live in tents and huts. Where are these terrorists getting this stuff? Oh, they're getting that stuff from Iran. How do they know where the ships are? Oh, they're getting the geolocation information from the Russians. So make no mistake, cui bono from all this? It's Russia, right? Because Russia is dividing the political interests, they're wedging between the attention and the financing in the U.S., all of that. The ability to get military aid and political support, all of that wedge is being driven by what's going on in this second front of Cold War II. The impact, of course, of the Houthi terrorism is the most important, and that impact has been to drive up the cost of shipping containers. We've seen that. I know you've seen this. The spike has been significant. We're up 31% from a year ago, but as we also see, the impact has been most significant, of course, from Shanghai to Rotterdam, which is 212% of the price of what it was a year ago, and Shanghai to Genoa, which is 145% of the price of a year ago. So we see these impacts really driving additional shipping costs as companies have had to avoid going through the Suez Canal. And of course, these are just the first two fronts of Cold War II. The third front is probably coming, right? Back in May, after the Taiwanese elected a new president, China surrounded Taiwan in an operation that they named Joint Sword 2024A. Now, you heard about my forecast track record, but I don't think you need to be a forecaster to know if you name something 2024A, you're going to do it again. And as a matter of fact, that's exactly what happened earlier this month, 2024B. Taiwan was surrounded a little longer with the Coast Guard involved. They went a little deeper. One of these times, they're going to surround and probably not leave. You know, the biggest navy in the world is the Chinese Navy. And every 2 years, they add the equivalent of the French Navy to their fleet. When you're a hammer, everything's a nail. And this is probably going to be something that we see as a problem going on moving forward. One of these times, sort of like as China built up a series of atolls into bases in the South China Sea, you're going to see a naval blockade. One of the reasons I say maybe we picked the wrong side to do the deal with at the end of Cold War I is because Cold War I really only got hot in Asia, right? Korea, Vietnam. That's why I think we might be here answering the China question for a while, because the naval regional ambitions are significant for China. But as we think about our own domestic politics, where there are disagreements about things, 80% of Americans view China as the enemy. This is something Americans agree on across the aisle. And so as we think about the future of conflicts, there are other potential hotspots. Venezuela, Serbia, Iran, North Korea. The Wall Street Journal has astutely called these the axis of evasion when talking about trade restrictions. And make no mistake, global supply chains are decoupling and reshaping. Back in 2011, there were 300 trade restrictions. Today, there's over 3,000. And the Section 232 tariffs, which affected aluminum and steel back in 2018, and the 301 tariffs, which were tech-focused, were just the beginning. I know some folks thought, well, these were Trump tariffs, and when Biden comes in, they'll go away. No, the Trump tariffs are here in purple, the Biden tariffs are in black, and whoever the next president is, there will be more tariffs and more trade restrictions put on China going forward. One of the most important in the last few years was last August, an executive order addressing U.S. investments in certain technologies in countries of concern. The countries of concern were China and the special administrative regions of Hong Kong and Macau. The technologies were quantum computing, AI, microprocessors, and semiconductors. And you might think, well, gee, the U.S. is really pushing this. What's the deal? Well, part of the situation is that in 2022, the Chinese issued a directive in something called Document 79. And it was something called the Delete A protocol. Look it up in the Wall Street Journal, look it up in the New York Times. This sounds very Bond villain, like I can't believe it. Delete A stands for Delete America. It's true. And the goal is China wants to delete the use of all US-made hardware, software in China. They want to end that. Which means, at some point, in the not-too-distant future, we will probably also be banning all Chinese-made internet-connected devices. Probably in a 5 to 10-year window, Chinese hardware, software in the US will not be something you can use. This is a big change. And of course, we are going to see the decoupling that does present opportunities, right? Like we are seeing this everywhere. The risks are big, but there are opportunities. Right now, a lot of investors and businesses are wondering, is China a good place for U.S. entities to invest? Don't take my word for it. U.S. Commerce Secretary last year called it uninvestable. Foreign direct investment, super weak. Back in 2021, $344 billion on net were invested into China. Last year, it was 15. You can see on the left the foreign direct investment or the imports from China going down. The yellow is Mexico, which is now our biggest source of imports. Some of that's transshipping, right? Stuff from China goes to Mexico. You take the stuff out of the made in China box, you put it in the HO in Mexico box, and you send it north across the border. That's going on. But in the renegotiation for NAFTA, the USMCA has a sunset clause which allows for renegotiations in 2026. This is something that the next Congress will be dealing with. On the right is U.S. foreign direct investment. You can see China in red going towards zero, India in green skyrocketing, Mexico is up, and the UAE is also up. And there's a lot of talk about BRICS and the dollar. The truth is, BRICS is an economic conference, yes. But currency unions are very tough. Look at the euro. People wondered, would that work? And that's with countries that have a shared history, shared geography, shared economy, shared political situation, right, and structure. The BRICS, do you really think China would ever let Brazil or South Africa, Russia run its monetary policy? I don't think so. So who are the big winners in Cold War II? It looks like it's going to be the non-aligned countries. This is data from the IMF. Cold War I on the left, you can see this is where the population is. 46% of the world lived in neither the Eastern or Western Bloc in Cold War I. Today, 66% of the world lives in neither bloc. On the right is the trade between them. Non-aligned trade was 41% of the total. After, and in Cold War I, in Cold War II, it's 51%. So you're going to see a lot more trade with non-aligned countries. And of course, population growth is going up in those countries. The Middle East and Africa is where we're going to see the biggest population growth through the mid-century. Other areas like India are still going up, but China's peaked, and OECD is kind of flattened out. So it's those emerging markets, non-aligned emerging markets, where we're probably going to see the biggest population growth. And real GDP per capita is going up. So global demand for shipping and goods, that's going to continue to rise no matter what. This is in 2021 purchasing power parity dollars, but it's the 2023 versus 2050 forecast. And a couple things I want to point out. India was less than $10,000 per capita in 2023. By the mid-century, it's expected to be between 35 and 40,000. China in 2023 was a little over 20,000, but it's expected to be roughly what the OECD Americas was, in other words, China and Canada, Canada and the US, by 2050. So you're seeing lots of emerging market growth everywhere. Wealth's rising, income's rising, but we are seeing these supply chains pull apart. Now, the last thing I want to talk about, because I love to end on a happy note, are political risks and the election. This is the easy one too, right? So prediction markets, I look at predictit.org, a lot's changed, right? We look back in mid-July, the odds of a Trump victory were at 68%, Biden 27%, Kamala Harris at 10%. As Harris became the nominee, by mid-September, 57% Harris, 45% Trump. Early October, it was split, and as of today, it's 46% for Harris, 59% for Trump. It's going to be very close. The House, because of redistricting, is likely to be Democratic. The Senate is probably going to be Republican, but there are some races, like in Texas, where I live in Austin, it's going to be close. Ted Cruz and Colin Allred are running a really tight race. One thing, though, the American public generally agrees on, two things, actually. This is Pew Research from a couple weeks ago. A plurality of Americans believe the next president will be terrible. A plurality also believe that the next president will change things for the worse. That's right. At least there's some agreements. So let's focus on what's likely to happen no matter what. Tariffs are likely to proliferate further. We're going to see further trade restrictions. Debt levels are likely to rise further, maybe a little more, maybe a little less. Sustainability is going to remain supported. That's got focus across the board, as well as from institutional investors, rating agencies, activist investors, and the general public. And Cold War II is likely to engender more supply chain and financial decoupling. The biggest risk related to this, in my mind, is an uncertain presidential outcome where we don't know who wins the election right away. This is not great. It happened in 2000 with the hanging chads, and it took until almost mid-December before Al Gore conceded, and then things moved forward. That uncertainty triggered a recession that started in Q1 of 2001. So what are the odds, like, we're going to see somebody concede if they lose it, right? So, like, if Trump wins, Pew Research, again from a couple weeks ago, based on a survey conducted from the end of September to early October, 27% of people think that if Trump wins, Harris will not concede. 74% of people believe if Harris wins, Trump will not concede. This is a big risk. Whatever happens, I hope it's decisive and it happens fast. Because if this gets stuck in the courts, it will be very difficult for the economy and businesses to plan. You'll see a loss of consumer confidence and potentially downside risks in things like equity markets. I'll give you an example. Mexico elected a new president this year, Claudia Sheinbaum. She was expected to win, and she won. And even though the person who was widely expected to win won that election, the main equity market ticker for the Mexican stock market, EWW, went down 25, 30%, and that's when the person who won. Why? The logic was, well, there were enough people elected in her party, also AMLO's party, the previous president, that the Constitution of Mexico could be amended so that judges are now elected rather than appointed. Well, it sounds like a big deal, but let me ask you, do you know whether judges are elected or appointed in any other G20 country? I don't. So it's pretty innocuous, but it could cause almost a third of the stock market to lose its value. What happens if we don't know who wins the election real fast? What will that do in, I don't know, the biggest economy in the world? So this makes me very nervous. So whatever happens, I hope it's over fast. Key takeaways, and we could talk more about the 3 elections, because there's actually 3, right? There's the election for the voting public, popular vote on November 5th. Then in middle of December, there's an electoral vote. And if there's no majority of electoral votes, you don't get 270, then it goes to the floor of the House on January 6, 2025, with the newly sat Democratic House, and Senate probably Republican. The trick is, even though it would be a Democratic House, you get 1 vote per state. 27 or 28 states will be Republican delegations. You get 50 votes because there's 50 states, 26 to win, which means even though you would have a Democratic House, you would end up with a Republican president. Republican and Democratic strategists know this, so this is going to be something that might play out in the courts after the election. Key takeaways. Economic growth is likely to improve as interest rates fall. Geopolitical tensions do threaten to massively disrupt supply chains, global financial flows. America's economics are likely to experience greater economic and financial integration. Emerging market and lesser developed economies present upside opportunities. And for ports, the big strategic implications are to focus on opportunities with strong U.S. growth, ensure fiscal discipline while interest rates are still high, even though they're going lower. They're still kind of high, right? Use AI and other tech to augment a wide range of roles, especially mid-office, back office. Prepare for Cold War II supply chain decoupling, as well as financial decoupling, and position for economic and financial integration among U.S. allies and across the Americas. And with that, the part I know you're all waiting for, the disclaimer. Everything could be wrong. So thank you. And with that, we're going to do some Q&A. Thank you.
Well, thank you, Jason, for a really interesting and thought-provoking presentation. Could you elaborate a little bit on the changes to trade patterns and implications for the ports? And in the meantime, when you're answering, there is an opportunity to ask questions, so think about what you would like to ask Jason to elaborate on.
Yeah, thank you, Lasse. It's a real pleasure to be here with you. I think the most important thing is we could see further trade integration among U.S. allies and with those non-aligned countries. So that means a lot less trade in the future with China. Look, even during Cold War I, there was trade between the blocs. Most of it was in commodities, agricultural goods, right? We were sending wheat to Russia and things like this. We're likely to see some of that. But anything that's considered a dual use or high-tech, capital goods, anything like that, we're going to see those supply chains further decouple. So we'll probably see a lot less trade with China, a lot more trade with Europe, and a lot more trade within the Americas and in Asia ex-China. So I would expect a lot more trade with India, where we're seeing that big spike in FDI, and a lot more trade in the Americas. Again, I would expect a lot of trade with Mexico, but the transshipment piece does need to be resolved for that too.
Is there any questions? We got microphones up here. Let's go one here.
Oh,
Yesterday we saw surveys that electric power demand in ports and other critical infrastructure is due for at least a 5-fold increase in the next number of years. And we know from discussions with utility companies, they typically can't deliver electric power in less than 5 to 7 years. So I'm wondering if your firm has looked at the impact of electric power shortages on economic growth.
Thank you very much for this question. This is one of actually the biggest challenges for the economy. I was on a a panel recently, and it was about AI, and people were talking about all the amazing things it could do, and there are massive power demands for it. And that means, right, we've seen massive power draws from things like crypto, we've seen massive power draws from AI, and yet, you think about all these wonderful things technology do, but we also expect power to be there. We need the basics. We need ports to be able to function. We need that to work. And these are the basics. I mean, I sit I'm the chairman for the Climate Change Advisory Panel for Sasol, a publicly traded fuels company in South Africa. And you may know, in the last year, there have been times, last year and a half, massive load shedding. Sometimes in the middle of the day, you'd have power go out for hours. Just all of a sudden, everywhere, power just out. That would not work well in a U.S. economy. That doesn't work well in a South Africa. That doesn't work well anywhere. These are the basics. There needs to be a lot more investment there. And so I think, in discussions Lhasa and I've had and other discussions, there's a lot more investment needs to be made around these critical infrastructure, not just power, but in the ports in general. Because if we're going to see, to the point we just also talked about, if we're going to see bigger trading patterns with Europe and the like, and I know y'all did a lot of work around the ports to dredge to be able to handle Panamax, but I have news for you. You need to start preparing for Suezmax. And a couple of years ago, when there were all of the ships waiting outside the ports of Long Beach and LA, I remember being in DC for a nonpartisan set of meetings around trade with most of the Texas delegation, both parties. As a CEO group I'm in that's affiliated with the Business Roundtable, another nonpartisan organization where we meet with people, both parties, on non-red meat issues. For agricultural groups, I actually have to explain I'm not talking about beef or cattle. I'm actually talking about, kind of the innocuous stuff like critical infrastructure, right, that everybody just assumes gets done. Anyway, so I'm talking to these aides of a congressman, and the Port of Houston's open. They just need to send the ships here from Long Beach and LA. Just send them through the Panama Canal. They can't get there from here. It's not like a rural Texas joke. You can't get there from here. They're like, well, what do you mean? I'm like, you can't get the ships through. And of course, these are younger congressional aides, and they're looking at me like I got three heads. I'm like, these are Suezmax ships. And they're like, yeah, just send them through the Panama Canal. I'm like, they're not going to fit. Like, what do you mean they're not going to fit? I'm like, there's different size ships. There's different size ships? They've been telling the congressman to tell everybody just send the ships through the Panama Canal. They were not happy. So at the end of the day, this is a physical, real-world problem. And what it also means is we should probably expect, if trade patterns are going to come maybe more from the east into the East Coast and into the Gulf, and not just the West Coast from China, if we're substituting supplies of goods coming from the Americas and the like, coming into the East Coast, coming from Europe, we might need to be prepared for Suezmax in those ports as well.
Any other questions? We got one here.
What are your thoughts on nearshoring, particularly the interoceanic corridor in Mexico connecting, I think, Port of Salina Cruz and Coatzacoalcos? I know there's a series of business parks that are being developed. Just like to understand your perspective on what should we expect out of that?
Great, thank you. Great question. So there's a couple things. So one, lots of opportunity to do nearshoring, both in the U.S. and in Mexico. Couple challenges. One is that what we see is there are some Chinese companies making lots of investments to try to get Chinese goods into the U.S. at a tariff-free rate. So that's going to be a challenge if we continue to decouple our supply chains. The second piece is that the unemployment rate and the birth rates in Mexico are lower than they are in the United States. Let me say that again. The unemployment rate is lower in Mexico than in the U.S., and the birth rate in Mexico is lower than in the U.S. So if you think your labor market concerns are tough here in the U.S., and I did a talk earlier this year in Mexico, they actually have a tighter labor market. So for them, getting people's even more difficult. So yeah, there's lots of nearshoring opportunity, but where are we going to get the people?
Well, Jason, I understand you've done some work on risks that we do not see. Could you talk a little bit to that?
Yeah, so this is, thank you very much for asking about this, Lasse. So the labor market, and then this ties into the last question, which is great. The labor market's tight, especially for physically demanding in-person roles, right? If I put up the list of all the open jobs right now, healthcare, transportation, warehousing, manufacturing, construction, but there are a couple other sectors where it's really competitive to hire, it's really tough to hire people right now. Physically demanding in-person jobs like police, fire, EMS. And there's one more category, which is defense. And in recent years, there have been shortfalls in recruiting for the Army and the Navy. This year, the Army's going to hit their number because they lowered their target. You may not be aware, but the defense bill for 2025 raises the U.S. draft age from 18 to 24 to 18 to 26. We don't have an active draft. There is a selective service system, and there are draft board candidates, like in the event of a draft, about 11,000 draft board candidates, of which I am one. It means you've taken the courses, and if you've vetted you, you're called up to review applicants who wish to be exempt from a draft. The odds of a draft are higher now than they've ever been. Of course, before we'd have a draft, we'd have what's called involuntary reserve recall, IRR. People who've done active duty as enlisted, there's a time window after their active duty, they can be recalled. If you're a commissioned officer, you can be recalled anytime up to, I believe, age 65. The current administration recalled people involuntarily last year. It was just several hundred. But there's about 1.8 million people who could be recalled at any time. Before we see a draft, we'd see involuntary reserve recall. Those folks would be raptured up. That would be a significant risk to physically demanding in-person roles across the U.S. economy. By the way, I know this might sound like an extreme topic to cover, but the research Lasse is referencing is stuff I did for the Joint Special Operations University at Special Operations Command at MacDill Air Force Base in Tampa. And I've been working on this for the past year. This is a real and rising risk because all of our allies in Europe have been having discussions about drafts. In fact, as of July of this year, first time ever, first time in history, there are multinational standing armies, NATO armies in Europe. Even during Cold War I, there were no standing NATO armies in Europe. There are currently NATO armies in Europe as of just this July. So that's a real risk where the labor force could suddenly, you could see some of your people raptured up, and even if they're not folks who work for you, other folks might just be gone from the economy, and the labor market would get much tighter, much quicker.
Well, thank you, Jason, for a very thought-provoking and interesting presentation.
Let me try to end. Let me try to end it on a positive note.
I have another question for you, which we're going in that direction.
Because it's a little early for the bar, so I want to make sure they stick around, you know?
Yeah, please do. So the U.S. economy, it's a very optimistic, let's say, scenario that you painted. Could you kind of elaborate a little bit more on that?
Yeah, I thank you, Lasse. Yeah, I mean, I think that's the big thing, right? Like, look, the U.S. economy is right now the strongest advanced economy, among the strongest advanced economies in the world. Was last year. It's likely to be among the absolute strongest this year. We are in a really great spot. Our labor market is really strong. So you have a lot of very positive dynamics going on. And as I think about the long term, I would say, look, there are three critical ingredients for economic growth, right? This is like, honest, there's a Nobel Prize awarded for this idea, but It's really simple. There's capital, there's labor, there's technology. Technology presents lots of opportunities. Labor, we have a really strong labor market. We have very low unemployment. That's good, right? I think getting bipartisan immigration reform and border security done in the year ahead, which I think is something we'll likely see. There are bipartisan pushes. Tom Suozzi, a Democrat from Long Island in Congress, and Morgan Luttrell, a Republican from Texas, are working together on bipartisan immigration reform. I think you are going to see progress. It's really good. So I'm optimistic we're going to get more labor in the places we need it. We're also, I think, going to get lower interest rates. So just to recap, capital, labor, technology are what add to growth. We have really strong growth right now. We're likely to see improvements in labor, improvements in capital, and improvements in technology going forward. I am optimistic of that. And for the ports, I'm optimistic you're going to see a lot more investment in critical infrastructure, especially as we move to the recognition that the world is changing and we need to make those critical investments.
Thank you, Jason.
Thank you, Les.
Yeah.
Thank you.